following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So, we are about to talk about money. This is The Answer. KLFE, The Answer about money. So, I've got a couple things going on today that you want to hear about. Number one, your financial advisor, if you have a financial advisor, may not be able to use that title much longer. You may lose a financial advisor. That's coming with some things later in the program. I'll tell you why once we get later in the program. I've got a guest today, has had a company for a number of years. You want to hear his story and what he has to say. But I want to start with the story of a man and his assistant in a very small town. It could be anywhere. And of course, it is a story. It's not real, but it's a story and it's an illustration. It could be anywhere. It could be in Costa Rica. It could be in Borneo. It could be anywhere where you have monkeys. And the story goes like this. The man and his assistant go into a town and they begin to spread the word that they will buy monkeys for $100 each. And so the townspeople in this village start gathering up all the monkeys that they can find. And this guy puts them in a large cage. And in the beginning, it's pretty easy to find monkeys, but as time goes along, it becomes more and more difficult. And as it becomes more difficult, the people begin to quit looking for the monkeys. So the man says, I'll tell you what, I'll pay $200 a monkey. And the people redouble their efforts, and they go out and find more monkeys. But after a few days, it's so hard to find, the people stop looking. So the man now says, I will give you $500 a monkey. And I have to go to the city, but when I come back, I will pay you $500 per monkey. So the people look around and think about what they're going to do. And the assistant who's still there says, I'll tell you something. In secret, if you don't tell anyone else, I will sell you all these monkeys for $350. So the people buy every single one of those monkeys for $350. And the assistant and the man are never seen again. You know, it's a con job and a scam, but it's also about growth. It's about how income grows. It's not just the value of something that stays constant. A lot of times, values increase, both in the price and the value of the company. So if you were tracking GDP per person, you would have seen that per person it's been increasing, and it has been since the 18th century. The Economist did a story, and I read a book called GDP, A Brief Affectionate History. I like the title. GDP, A Brief Affectionate History of GDP, written by Diana Cole. And there's a discussion of economies and growth. And with the tax revision bill which ended last year, the tax bill was intended to stimulate growth, to grow the economy, to kick up GDP growth, and to make things grow faster. And the question is, will it do that? Einstein said this about light. No matter how, no matter where, no matter when, or no matter by whom it's measured, the speed of light in a vacuum is always constant. Think about that. No matter how, or where, or when, or by whom it's measured, the speed of light is always a constant. You know, economists and politicians would have you believe that the economy and growth is like that. It's not. It's not constant. Even GDP is not well-defined and fixed. William Nordhaus of Yale University is a professor there. He talks about GDP and talks about the change in price of things that people have bought. From 1800 to 1992, if you look at the price of candles versus tungsten, you will pay about 3 to 5 times as much for a tungsten light bulb as you would pay for a candle. We've moved beyond the tungsten light bulbs, but between 1800 and 1992, we pay about 3 to 5 times as much for one of those light bulbs that fit in the kitchen or on the desk or whatever as we paid for a candle in 1800. But if you measure the number of lumen hours that the two produce, the tungsten light bulb versus the candle, how much light they produced as measured in lumens and hours of production, the price dropped on candles. It didn't rise on the tungsten light bulb 3 to 5 times. It dropped by somewhere between 100 and 1,000-fold. So measuring things with GDP, it's a highly complex thing, because what you're trying to do is take all the value of the products that are sold, and it's across a wide range of industries, and you take all the inputs and you add those together and you weight them according to the importance of the economy. You've heard it said, or you should know, if you know much about GDP, that 70% of GDP is related to the consumer. It's the cars we buy, the televisions, the house we buy, the medical care. If you go back only 20 years ago, it wasn't 70%, it was like 67%. So the amount of weighting changes. But it's also a question of what you're measuring, because a TV today is not the same as a TV in 1960. A car today is not the same as it was in 1960. The telephone is not the same. They didn't have smartphones. We didn't have computers, personal computers in 1960. So it's a constant change of what we're buying and what makes up the GDP. If you go back to when GDP was first measured, as far as we know, the first measurement of GDP goes back to a guy by the name of William Petty back in 1665. And what he wanted to do is estimate the income and the expenditures, compare it to the population and the land and the assets of the people in England and Wales and the product and the produce. He wanted to assess the country's ability to fight the Second Anglo-Dutch War. And you finance wars through taxes. He wanted to prove that England could bear a higher burden of taxes and would be capable of financing that war between 1665 and 1667. That was why GDP was first developed. John Maynard Keynes updated it in 1940, and once again it was war, this time World War II. The question was, what could the UK produce with available resources to fight the Germans? We think of war in a whole lot of different terms, but very seldom do people think about it in what are the capabilities do we have to fight the enemy? What were the resources for mobilization and conflict? And for Maynard, John Maynard Keynes, he was really angry about the inadequacy of the statistics that supported what he was trying to do. And he wanted to know, if we allocate all these resources for fighting the Germans, how much is going to be left for the people to consume? How much will the living standard of living fall? How much has to be produced by the individual industries and for what materials? But it's a constant change. GDP is a constant change. When you think about it, I mentioned the cars and the radios. Think about the refrigerators and the washing machines. Those people who grew up in the Great Depression didn't have washing machines. They didn't have refrigerators. Teenagers. Just think of the term teenagers. That word was coined in the 1960s because teenagers, prior to that, were not significant consumers of the economy. In telephones, in 1970, in the U.S., 94% of the people had a telephone. But in France and the UK, it was less than 50%. Cars in 1960, 75% of the population had a car, but less than 30% in the UK and France. Smartphones, look at the smartphones. No one had a smartphone in 1980. Today, there's a billion or more smartphones. So there's a constant change, not just in the U.S., but in all these emerging countries as well. From 1968 until today, a number of countries are still using weights of products from 1968. There's a study of 45 different countries, and 24 have not made a single change in their GDP calculation since 1968. Think about that. How do you really know what the GDP is when they have not made a change in 50 years? When prices and weightings are updated, it's a significant change in the strength or the weakness of the economy. And it's a value used to estimate. We're going to come back and finish this. Don't go away, because this has an impact on investments and what we've got going on. So don't go away. I've got a great story, a great guest, and your financial advisor may not be a financial advisor very long. We'll be back in just a minute.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about GDP and what goes into GDP and growth. And that brings really the question of how do you measure a country's growth? And what is growth in a country's economy? Why do some countries grow and others don't? The reality is economists have a very difficult time explaining growth and why a country grows and why a country doesn't grow. There's very few hard facts. GDP per person, as inaccurate as it is, and I talked about that in the first part of the program, it started growing in the 18th century. We started to see an increase in GDP per person. You can begin to see it in wealth. You can begin to see it if you track it. And if you visited the Louvre in Paris, you can begin to see the change in focus if you walk through the salles, the halls. The salles are the French word, of course. The halls, if you look at the paintings, you can see changes taking place on who was purchasing the paintings. That was an indication of growth of GDP. So some of the things we do know is that countries become rich by growing steadily over long periods of time. In some ways, it's about new technologies and more productivity, new ideas. But beyond that, almost everything is a question. And I could be wrong, but I believe it's important to understand. I think it's the mile-high view. No company, and we own stocks and companies, no company operates in a vacuum. They operate in those economies, growing economies and stagnant economies. And I'm here, and I manage portfolios put in terms of the story of the monkeys. I don't want to make the mistake of buying back the monkeys at $350 that we sold for $100. I want to see what causes countries to grow and not grow. And there's three broad lines of thinking about growth. In 1956, Robert Solow and Trevor Swan proposed the Solow-Swan model. Prior to that, everything had been focused on the Keynesian model. Keynesian talked about growth was a function of spending by private and government functions, private companies and government entities. And that was the concept. If you look at 2008, 2007, when we were in that Great Recession, the idea was to pump money into the economy, government spending, to stimulate the economy, and it worked. That was the Keynesian approach. In my opinion, it still has validity, and it was borne out, but it's only part of the story. When you don't have a Great Recession, you have things going on that cause countries to grow and not grow. Solow and Swan proposed a non-linear approach to growth, whereas Keynes said the more money you pump into the economy, the faster the growth, and it can create inflation. The less the money that you take out will cause a growth to slow down or retract. The Solow-Swan model was nonlinear, which meant that it consisted of a lot of variables. It looked at capital accumulation, it looked at population growth, it looked at technology and productivity. But as people looked at it in more detail, it was vague. The assumptions, as Paul Krugman, a Nobel Prize winner, said, the assumptions of unmeasurable things affected by unmeasurable things were unmeasurable. I like that quote. The assumption of unmeasurable things affected by unmeasurable things were unmeasurable. Some countries do grow rapidly by adapting new technologies, but other countries adapt new technologies and don't grow at all. And out of that came a second approach to growth, which was the growth accounting model. And they looked at the relative value of capital and labor with a whole ton of variables. Again, it was nonlinear, but they looked at the rate of capital accumulation, of labor, of education, of new business formation, and on and on and on. And they built a model, but the reality is that second approach is very, very complicated, and you have interrelations between those, education and labor cost. The third has been a historical approach, looking at the culture of countries. A number of times I've talked about China and how it's grown. It was a focus on mercantilism, the same growth pattern that France experienced in the early 1700s. Why did China grow? Why did France grow? There was a pretty good focus. So mercantilism was the focus of those countries. If you look at Singapore, the focus is completely different. If you look at the U.S. economy, it's different. If you look at France or in England and some of the other countries, it's still different yet. A lot of the data is out of date. But those are the appropriate things. And what that all boils down to is thinking about where things are going from a mile-high basis. I've talked, and I've been talking for almost a decade about the supercycle, the study that was done by Standard Chartered Bank of the UK. And they said that we live in a time of a supercycle. That's when average GDP growth worldwide grows at a faster rate than average. The first supercycle from 1870 to 1913, driven primarily by the industrialization of the U.S., but it wasn't just the U.S., it was a worldwide growth. The second cycle from 1945 to 1970, driven primarily by the reconstruction of Europe, by Asian exports, and by the decolonization of the world. And those countries that grew up, had been colonies, became real countries. The new cycle they identified in 2009 is driven by the emerging nations. By 2030, the forecast is that 93% of the world's middle class will live in countries that are emerging. These are the Brazils, the Indonesias, the Russias, the Turkeys, the Sub-Saharan Africa. These are the countries which will provide an extraordinary growth. And by extraordinary, it's not a 20% GDP. It's 5 or 6% GDP. These are the countries that are going to provide it. And that has an impact. There's big risk. There's political volatility. You have to look at things like Arab Spring. You have to look at what's happened in Russia, the Ukraine. You have to look at what's happening with China and the tigers, the Southeast Asia tigers. You have to look at those countries because those countries are less transparent, they're less stable. Investment can be more vulnerable and subject to politicians and bureaucrats. Corruption can be epidemic. It's a fundamental shift in the balance of power. Every supercycle has its winners and losers, and this one will be the same way. I don't invest in many companies that are not domiciled in the U.S. I look at companies which have a significant footprint in the rest of the world, but they're domiciled here. Investing is not a zero-sum game. It's a focus of knowing where you are and what the approach is. But to miss the growth that's going on in the rest of the world is to miss the potential of significant gains. But to do that, you also have to think about what countries are growing and why they're growing, what's happening worldwide with the growth. It's not just an expansion of the middle class, because that has a significant impact on growth and in those countries. But it's how they're growing, the productivity, the technology, and how things are happening around the world. Understanding that can make better decisions for the investments, even with U.S. domiciled countries that are taking advantage of growth areas in the rest of the world. I think it's all important to understand, and there's very little explanation as to what makes countries grow and what makes countries not grow. But it is, you can look at historical growth and look at current growth and changes in those growth records and translate that and think about that in terms of the investments you make and the portfolio and building your portfolio of investments. Anyway, that's enough for that. I want to get to my guest today because he's got an important story to tell. And I also want to talk, when we're done with that, talk about financial advisors. You may be losing a financial advisor. We'll talk about that right after the interview. But first, I want to introduce my guest, Earl Overstreet II, President of General Microsystems. Welcome to the program, Earl.
Thanks, Mike. It's a pleasure to be here.
So why don't we start with your background? Tell us about yourself.
Well, Mike, from an education standpoint, first of all, I grew up in Cleveland, Ohio, and went to school there, received a Bachelor of Science in Mechanical Engineering from Case Institute of Technology and an MBA from Case Western Reserve University. Worked in manufacturing and distribution and technology, and working for General Electric and Wiley Labs, and started my own business, General Microsystems, 35 years ago.
And you probably outlast General Electric at this point.
Certainly some of the generals. I'm not sure about General Electric.
Yes. So you started your business, but you started in Cleveland, and your education was there as well.
That's correct.
So how did you end up in Seattle? Tell us about the route you took from Cleveland.
From Cleveland, after graduation, I started to work for General Electric, and I was in manufacturing. Went back to school to get my MBA and fell in love with marketing, and I really thought that was something that I wanted to pursue as a career path, and felt that sales was the best route to take to get into marketing, since I didn't have a formal marketing education. So I ended up applying for and getting a sales engineer position in the Bay Area. Worked there for a number of years. I transferred back to Cleveland in a marketing position, left GE, and went to work for Wiley Labs in the Bay Area, and Wiley Labs subsequently transferred me up to the Pacific Northwest in 1980.
So you came to Seattle via San Francisco, Cleveland, and then back to San Francisco, or the Bay Area.
Correct, exactly, yes.
So we're coming to commercial break. Don't go away, because we're going to come back and we're going to find out about General Microsystems. We'll be right back after this break. Don't go away. Lots to cover.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Earl Overstreet, president of General Microsystems. We just got to the point where he said that he founded General Microsystems in, I've forgotten the year already.
1980.
1980.
Excuse me. That's when I moved to the Pacific Northwest. It was actually 1983, so 35 years ago.
35 years ago. So you started it. Why did you start the business? And tell us about the business itself.
Well, when I left Wiley, I was looking at what to do next, and my first reaction was to go to work for another large company. That was my background and experience at the time. But I decided rather than to make a snap decision, I would take a long delayed vacation, and I went off to Hawaii to think about what I wanted to do next. And while sitting there on the beach, it hit me that maybe it was an appropriate time to start my own business, that if I was going to do that, that this would be a good time, being relatively young and at that time single. And I was actually surprised that was the thought that came to me, because I had an uncle that had a grocery store, first African-American grocery store owner in Cleveland, but I never thought that was something that I wanted to do as a career. But the more I thought about it, the more attractive it sounded to me, and I decided that that really was what I was going to do with my next career step. So spent some time thinking about what, and it occurred to me that the computer products area, with the advent of the personal computer at that time, would be a good starting point. Being a new business, starting with a new industry rather than an established one, made more sense to me. So that's what I decided to do when I got back from vacation.
And that was a time, it was almost like the Wild West in a lot of ways. You had a lot of small companies that were building computers. You had a lot of suppliers of miscellaneous products. You must have seen a lot of things going on at that time.
It was an exciting time, Mike. It was also pre-internet, so I did my research by going to the library and magazines and phone calls, and it was a very, very different market. But it was exciting because, once again, as a small company, we didn't have the prestige or the financial acumen to be able to sell IBM PCs, but we did have alternatives. So we were able to get into the market selling some of the IBM clone products, as well as a number of the products that worked with the IBM PC to increase memory or add other capabilities. So it was a great time for innovation, for small startups to be able to get going and establish themselves in a fledgling industry.
And it was a little fledgling industry, because I remember at around that time, just past that time, is when I bought my first computers, one for home, one for business. And in those days, you could buy a computer that had 60 megabytes of memory or 100 megabytes. And I thought when I bought 100 megabytes, I was set for the rest of my life. How times have changed, huh?
Indeed.
So as you've seen all those changes take place. And most of those small businesses that started when you did and were they supplying computers, were supplying supplies, most of them are now gone. You survived all that.
Well, not only were we able to survive compared with some of our smaller competitors, but I look over the landscape of larger competitors over the years, and we were starting at the time that the mainframe was still the primary computing platform, followed by the mini computer, and then you started to see the evolution of workstations and other products. But again, you look at the landscape of even large companies at that time that are no longer there. That really shows you how much the industry has changed in 35 years.
Well, yeah, you see, Data General and all those companies that are completely lost in history.
Exactly. Xerox, Wang, digital equipment. You can list a very long list of companies, again, large and small, that did not make the transitions over the years to still be in business.
So you must have reinvented yourself a few times.
I think a very conservative estimate would be 5 times over 35 years, but yes, we have, and we really look to our customers to give us the insights in terms of what should be next in our business. So we really tried to stay attuned to challenges and obstacles that customers were facing, at the same time being aware of technology and the technology changes and trying to match those changes with the changing needs of our customers to evolve our business to meet the changing needs of our customers.
So in the early days, tell us about the early days and the significant change that happened.
Well, I think one of the most significant changes for us, Mike, was After about a year, as a business that we were again focused primarily on the personal computer products, we were approached by a gentleman that I'd worked with when I was with Wiley Labs, and he was with Digital Equipment, and he had started. He had opened an office for one of the workstation manufacturers. At that time, there were 3 or 4 different companies that had developed using the Unix operating system, and Unix is still around today. But at that time, it was really focused on high-end research engineering kinds of applications. And this sales rep had sold one of his computers to the Applied Physics Lab at the University of Washington. And the plan was to take this computer up to the Arctic to run some acoustical experiments. And when the scientists did the calculations, they determined that they were going to be collecting 11 gigabytes of data. And this is 1984. And 11 gigabytes of data was an astronomical amount at that time. Today, you could put that on your cell phone. But at that time, there really was no device that could accommodate the storage capacities that they needed. So we were approached to come up with a solution, and we were able to do that. We worked with some computer scientists that had just graduated from the University of Washington to write the software. We did all the other integration work, and we delivered that system to the University of Washington, and they took it up to the Arctic, and it was successful, and they collected all the data that they needed for their experiment. And
you went on to make that, I assume, a product that you carried in the line for the rest of your customers as well.
Exactly. We had about a 10-year run with a storage product line that we expanded. We offered additional products, different technologies, and we're very successful with that. Again, as a 2 or 3 person company, having customers not only within the U.S. but even some international customers was a very exciting time for us. And it also transitioned us to the next phase in terms of working with Sun Microsystems, which was one of the workstation providers at that time that we provided storage for, ending up then reselling their computers, and that was yet another phase of our evolution as a company.
So let's fast forward to today and tell us what you're doing today to help your customers.
Well, today we've recognized, and I think one of the real turning points for us was the Great Recession. Was recognizing that at that time we were still primarily focused on Sun Microsystems. We needed to diversify our not only our product line in terms of storage and computer products, but also more services to meet the changing needs of our customers. So now we're involved in cloud and security and operations services, as well as continuing to offer the infrastructure products, computers, servers, and storage that we have in the past. So we're recognizing that our customers now have more choices to make in terms of not only what types of technologies they're using, but where those technologies are running, whether they're on premises in their own data centers or in cloud, public or private. And so we've adapted the professional services and support to help those customers get the most out of their traditional data center products and services, or to move to whatever other flavor, whether it's software as a service or cloud, that meets the model that they want to move to as they transform their IT operations for the future.
So a lot of people talk about moving to the cloud or using software as a service. Tell us how you go about assessing that for a company.
Well, I have 4 things that we really recommend when we're talking to customers about IT transformation or information technology transformation, that they look at 4 basic elements to help them along that journey. And the first one being visibility, understanding what their environment looks like, what is today, and what are the benchmarks and performance and capabilities of today. Then figuring out how they analyze that information, either themselves or using companies like General Microsystems or others to help them to see what their choices are to transition to whatever they want to do next. And then looking at how they automate, again, either themselves or using technologies to automate all of the moving parts that are part of a modern architecture, and then how they delegate, either managed services, be it cloud, or user empowerment to do some of their own self-service IT work. And that is our model for IT transformation in the 21st century.
That's awesome. So you've got a marvelous story. You've got a marvelous company. Tell the listeners how they would get a hold of you if they think they might have a need for using your services.
Well, Mike, we certainly would love folks to visit our website at www.gmi.com and get a better sense of the kinds of products and services that we have available. They can also reach us at sales@gmi.com or info@gmi.com. And certainly we're out of our office in Bellevue. We'd be happy the traditional way to pick up the phone and call us at 425-644-2233.
Okay. Well, thank you very much for being on the program. And it's a tremendous story. You don't hear many companies that have been around in your area for 35 years. So remarkable story. Remarkable that you've done that.
Thanks, Mike. We're really proud of our accomplishments, and it's been a pleasure to be on your show. Appreciate it.
So we're coming to a commercial break, and I want to come and I'll finish off the program talking about what's going to happen with financial advisors. We'll be right back right after the commercial break. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So welcome back. And I want to talk about what's going on. But I want to tell you the story first. Back in the mid-1700s, Catherine the Great was the ruler of Russia. And she not only visited a number of countries, she went to Russia, or she went to France, she went to England, she went to the Austrian-Hungarian Empire. And now it was her turn to host a number of top rulers of the rest of the world at that time, mid-1700s. But she went out and she looked at some of the villages that were in Russia. She wasn't very impressed. So she turned to Field Marshal Gregory Potemkin. And she wanted Gregory Potemkin to build some fake villages that would give the illusion of prosperity. It was totally illusionary. People didn't live in these villages. People had never lived in these villages. And it was simply built for the purpose to impress the visitors. And now we have this phrase, a Potemkin village. It's a metaphor for things that look elaborate and impressive, but have no substance. And in my opinion, it falls along the same lines as a world of spin we live in. We no longer say taxes when we're increasing taxes. We're enhancing revenue, which means you fill out your tax form and you're going to pay more. That's enhancing revenues. When a business fails, it's non-performing assets. Of course it's non-performing assets. It died. In military times, instead of saying you caused civilians to die, civilians' deaths, it's called collateral damage. Collateral damage. We killed innocent bystanders. Don't say that. We say we had some collateral damage. And two that I really love. One is vertically deployed anti-personnel devices. We used to call them bombs. Now we call them vertically deployed anti-personnel devices. Used to say we were trying to kill the enemy. Today we say we're servicing the target. I mean, we live in a world of spin. And that's happening in my industry. So I want to talk to you about what happened on Black Monday in 1987 because the market plunged over 30% in one day. I've recounted that story of what I was doing. I was so enamored with what was going on or so amazed by what was going on, I couldn't make any calls. I just sat there and watched my Quotron, which is what we had for a screen in those days, watched the market go down, start to rally, go down, start to rally. But that crash meant some very big things for big companies because it caused a lot of revenue loss. People quit trading. Until the 1987 crash, people that licensed like I did, that had a license, we were called stockbrokers or bond brokers, because that's what we did. We were the middleman between a buyer and a seller. That's what we did. And we charged a commission for doing that. But when revenues took the plunge they took, 1987 was a huge drop in company profits for the brokerage firms. When that happened, the brokerage firms had to solve the problem of how to get revenues back up again. Paine Webber, who I worked for, had one approach. Merrill took a different approach. They went out and they required all their stockbrokers to become financial consultants, financial advisors, and everyone was required to sell financial planning. If you didn't sell financial planning, you got dinged and you lost money. What was the difference between a financial consultant, financial advisor, and a stockbroker in those days? Nothing. It was a Potemkin village. Very set to impress, but no difference. There were brokers in between. And financial advisor, however, implied a higher level. It implied advice. And Merrill Lynch began to require all their financial advisors, no longer stockbrokers in name, but financial advisors in title, to sell financial plans and to gather up the assets of their clients. The idea was to go out and consolidate the assets. And if you've been in this business very long, if you've been around financial advisors, you know what they say. You need to consolidate your assets in one place. I actually prefer a lot of my clients to have assets in different places so they can compare how I do to someone else, because I'm a numbers guy. But that's not the deal for most. It was the same thing. But it became financial advisors. We became not stockbrokers, but financial advisors. We became more casual in our clothing, more official in our title. I guess the average worked out. But that's about to change, because there has been a difference. When I got into the industry, the big brokerage houses in full-service brokerage had over 90% of market share. Today it's about 50%. What's grown up are the registered investment advisors. That's what I am. We're fiduciaries rather than being registered representatives. But there's a lot of confusion over that. Registered representatives only have to make recommendations for suitable products, not in the best interest of the client. Well, it seems the same. While the titles have been the same, it's not at all the same. Dodd-Frank was passed in 2010 requiring the Securities and Exchange Commission to come up with a fiduciary definition or a fiduciary rule. They have just proposed that. And part of that is to take away the title of financial advisor from registered reps. For those people who work for Merrill and UBS and Morgan Stanley, that title is going to disappear. They're back to being stockbrokers or bond brokers. That's what they were in the first place. That's what we were in the first place. I worked for a long time. They will also have to do some additional things. They're going to have to do best interest standard for brokers. So it's the fact that it raises the standard to make those registered representatives, those stockbrokers, have to do what's in the client's best interest. I have any number of stories. I spent 18 years in that world, and I can tell you any number of times when we made recommendations, when we did things that were in the company's best interest, even at the expense of clients. That now supposedly will be coming to an end. Yet, my question today, when I licensed in 1986, the big brokerages had 90% of the market. Today they have less than 50%. Merrill at the end of last year came out and changed the compensation schedule. Brokers now get paid a percentage of revenues. Now they get 1% more if they bring in 5 new accounts of $250,000 or 2 ultra-high net worth, $10 million or more. They get deducted 1% if they only bring in 3 new accounts or 1 high ultra worth. and they can get deducted 2%. And what the impact of that is that the brokers have increased their gathering by 60% first quarter of 18 as opposed to 2017. And Bank of America now is requiring Merrill brokers to do 2 referrals a year for banking business or face a 1% penalty. And you know what it reminds me of? Wells Fargo did those same things. Wells Fargo just got a fine of $1 billion. And now Bank of Washington wants their Merrill brokers to refer at least 2 people for banking services. You know, the more it changes, the more it stays the same. It's a Potemkin village. But at least the financial advisor title is going to go away. For those guys, for some of us, it'll remain. Next week, got a lot more to cover on any number of subjects. Don't go away. We may revisit bond vigilantes. I've got a lot more to say on that. No time. Ran out of time this week. Next week, more on that.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. Following program is sponsored by Adams Financial.